Hello everyone, I am Aisha Salman with ASA and welcome to today's webinar. In this session, we will review highlights, answer your questions, and offer suggestions on how companies can get the most from the results of the American Supply Association's 2019 Operating Performance Report, OPR. Please note that this one-hour webinar is being recorded for replay. Everyone registered for this webinar will receive a follow-up email message with notifications as to when the replay is available, as well as instructions on how to access it along with the presentation slides. Before we get started today, I'd like to be sure we recognize our 2019 supplier partners who are truly dedicated to the positive development of the PHCP and industrial mechanical PVF industry through ASA. When making key decisions in your business, please consider these corporate partners that go above and beyond with their support to advance the association's efforts, programs, and services through advocacy, education, networking, and business intelligence. One of the association's strategic goals is that ASA members will be more profitable and sustainable as they deliver world-class supply chain efficiency in a changing marketplace. For 36 years, ASA has partnered with Industry Insights, Inc. to provide the only source of industry-wide financial and operating performance benchmarks for the PHCP and industrial mechanical PVF wholesale distribution channel. Today, the annual OPR is part of a total suite of business intelligence reports that provide ASA members with reliable and timely industry data to use when making strategic decisions that fuel growth. This year, we launched a business intelligence dashboard, which hosts all of our BI offerings, inclusive of the OPR, quarterly sales benchmarking report called Pulse, compensation study, which is held every 2 years. Next one up is in 2020. Economic reports and forecasts, business valuation, and a new offering, which is our sales forecasting tool. Our presenter today is Tom Noon, who founded Industry Insights in 1980. Tom's expertise includes the areas of financial analysis, business valuations, profitability planning, and productivity improvement strategies. He has served as a project director in a variety of research and consulting studies for both U.S. and European public and private firms, as well as numerous trade and professional associations. Additionally, Tom has played a major role in both design and presentation of executive development programs in the United States and Western Europe. As you read the Wall Street Journal, U.S. News and World Report, and a number of other trade magazines, you may see Tom quoted. One last note before I turn it over to Tom. We encourage you to jot down any questions you may have. We will have a question and answer session at the end of the webinar. That concludes our general information, so at this time I will turn the program over to Tom.
Well, thank you, Isha. I appreciate that introduction. And I appreciate the opportunity to be here with you today to share with you the results of this year's ASA Operating Performance Report. Now, I'm sure you all know this is a benchmarking type study. It's an objectively prepared benchmarking type study that provides financial and operating ratios against which to compare your own company's performance. And having said that, we've learned many things over the years about what leads to high profitability in the industry. So what I'd like to do in this session is talk about, first of all, why is benchmarking important and why is it another tool for you to help you control your business together? What are some of the important features of the study? And then I also like to mention and familiarize you with what Aisha just mentioned, the Business Intelligence Portal or Dashboard, which is an exciting new offering from ASA. Then I'll get into the actual highlights of the study and then take you through a hypothetical company analysis so that you can see in a very short period of time, you can get a great deal of insights about your business that may not otherwise be possible. Then, in addition, something we do in the study every year is we take a look at the profit leaders or the high profit companies and try to differentiate or understand what leads to their high profitability. And for this purpose, we separate out the top performing companies in each group of companies by one measure, before tax, return on assets. So we put all the top 50% best performing companies into a group by themselves, then run all the measures for that grouping of companies. And what we find is that for certain measures, those companies don't even do as well as the other companies in the industry. But other measures, they consistently do better than other companies in the industry, so we can conclude that's what leads to their high profitability. Then I would like to make some other comments about what we've learned by doing the study over the years and give you some tips for using this study. Now, keep in mind, the operating performance report is done on a strictly confidential basis. Nobody at ASA, nobody in the industry, nobody other than a select few people at Industry Insights ever see anybody's information. And even within Industry Insights, we assign a confidential code number to your information and try to handle it as, to the extent possible, totally anonymously, so that no one's information is ever known by anybody. As a participant in the study, you receive two separate reports. You receive an overall industry-wide report that has all the data groupings, as well as analysis and ratio definitions and other information. And you also receive what I consider to be the number one value of the operating performance report, and that is what's called the Company Performance Report, or CPR. And what this is a customized confidential report about your own company that shows all of your information calculated in the same manner that's calculated in the overall industry benchmarks. And then alongside your own company's information are the comparisons for companies most like yourself. So it's a very useful tool for seeing how you stack up. Now, within the company performance report, there are a number of features. First of all, there's something we call the report card, which looks at a number of key measures and just gives you sort of a quick assessment as to how you stacked up for that particular measure. And this will show whether or not you are strong, good, fair, or poor for each of the various measures. Now, this isn't perfect, obviously, but the idea is to try to raise red flags of areas that you might want to look at in more depth. Also, in the company performance report, there is trend information for your own company if you've participated in the OPR for a number of years. And we show up to 5 years of trend information for your company for each of a number of measures in a graphical sense, but for all measures in a tabular sense. And the idea here is that it's useful to look at yourself versus the industry-wide benchmarks, but it's also useful to look at yourself over time, because you can see if any adverse trends have occurred for your own company over time. And in this, there are, as I said, graphs where we take individual measures. This particular sample graph is net profits before tax to total assets, or return on assets. And on each of these graphs, there is a solid line, which represents your company's performance for that measure each year over the last 5 years. And I'm using a hypothetical company here. Obviously, I'd never use anybody's real numbers, so that's why this is an absolute straight line. I put in the same numbers for this company for every year. In addition to your own company's numbers, there is the industry typical company's numbers for that particular measure. So you can see if you're above or below the typical company in the industry. In addition, the shaded area represents the middle 50% of performing companies for that particular measure. So again, you can see how you stack up. Do you fall within the middle 50%, or are you outside it like my sample company is here? So on each of these graphs, you can get a wealth of information very quickly just in a picture form. As I said, we also show trend information in a tabular way so that we'll show your performance over the last 5 years for each of the measures in the report. Then in addition, in your individual company performance report, there is information for you versus the industry norms for all the different data groupings that are most like your company. And what I'm showing here are just the data groupings for some broad groupings of companies. This will be much more specific for your own company. So there'll be a column of your firm information, but then there's also all the different data groupings for each of the different comparisons that are most like your company. So in a very quick way, you can look how you stack up. Okay, well, why is benchmarking information important in the first place? Well, it's important because it gives you information that's not possible just by looking at the dollar amounts of your financial statements. For example, if you said, Tom, we had a great year last year. We had $1 million of profits. Well, I don't know if that's good or bad. If you did $1 million of profits and you're a $10 million company in revenues, that starts telling me something. You had a 10% profit on sales. But if you did $1 million of profits and you're a $100 million revenue company, that's a little different picture. That means you did 1% profits on sales. So that's why it's useful to look at one number versus another, or a ratio. Well, just as looking at the dollar amounts doesn't tell you all you need to know, neither does looking at a ratio all by itself. For example, if you told me, Tom, I'm a plumbing supply company and my payroll and fringe benefits last year were 20% of revenues. Well, I don't know if that's good or bad, but I do know by virtue of doing this study that the typical plumbing supply company had payroll costs, including fringe benefits, that were 16.8% of sales. So if you're at 20% and your peers in the industry are at 16.8%, that raises a red flag to me. Why are you different? Is there something that's a profit leak there? Is there some opportunity for improvement? And maybe we can fix it. So that's the value of this study, to provide you those kind of benchmarks. Well, obviously, your own historical performance can provide you a benchmark as well, but this study provides you versus industry peers. Keep in mind, however, that if you see a difference between your company and the other companies in the industry, that's not necessarily good or bad, but it's a signal of area to look at in more depth. It's a red flag. It may not be a problem at all, but at the same time, maybe it is. And I maintain that even relatively simple analysis using this information can result in significant insights about your business that are not otherwise possible. Now, I realize you're all out there busy as can be, fighting the fires of running your business on a day-to-day basis. So you might say, wow, I get this information back each year and it's just overwhelming. Well, I'm going to focus in this session on what we consider to be the key measures that you should look at first, and let that dictate other things to look at in more depth. And I'll kind of summarize that at the end. But the idea here is that even in a short period of time, you can get great insights about your business. And I'll try to demonstrate that in that hypothetical case example company that I'm going to look at here. Okay, the report is very detailed. It has measures, all kinds of different measures for your company. There's something like 130 different ratios in the OPR. So again, it can be overwhelming, but if you focus on some key things, that'll dictate what to look at in more depth. In an effort to try to get an apples to apples type of comparison, we break the data a number of different ways. First of all, we show it for all responding firms, but better yet, we show it by type of company you are. If you're a plumbing supply company, you can look at yourself versus other plumbing supply. If you're a PVF, you can look at yourself versus other PVF. If you're a combination plumbing PVF, there's a data grouping for that, and there's another data grouping for HVAC and other companies. And then within each of those data groupings, the data is broken down further by sales volume size. There's that high profit company break. And then in addition, on an overall basis, we also look at the number of branches and geographic region information. There's also a data grouping for very large companies, companies 150 million in sales and over, and the smaller companies, 15 million in sales and over. So the idea is no one is identical to your company, but hopefully you can find data groupings of companies somewhat similar to yours so that it becomes very meaningful to you. Well, over the years, the study has evolved. Every year we add new information. It's sometimes difficult to even know what's new each year, but many times the suggestions that you provide in a session like this by shooting me an email are things that we can do to improve the study going forward. So we're always open to those kinds of suggestions. Okay, well, what's new this year? Well, there's two new basic ratio items that we've added this year. We show estimated percent of total inventory that is dead stock. This is inventory that has not sold for a year or in which you have more than a year of supply on hand. And that's a very useful tool, hopefully, for giving you a feel for how well you're managing your inventory. And we've also given, in this year's study, expanded earnings before interest and tax ratios, and also earnings before interest and tax, depreciation, and amortization, to give you another sense for, in this case, your free cash flow and how your profitability is based on that. Then, as I mentioned to you at the outset, and a very exciting new feature that ASA is making available to you is the Business Intelligence Portal. And this includes the OPR, which we're talking about here today, the Quarterly Pulse Report, Sales Forecasting Tool, Compensation and Benefits, the ASA Advisor, which is economic information, and also information for having a business valuation done about your company. The Business Intelligence Portal is literally ready to be unveiled very, very soon. I'm going to say within the next several days, actually, but certainly by the time you all view this, a recording of this, you will be able to do this. And what this is you get on the Business Intelligence Portal, you click any one of these icons, and that'll take you to either the OPR, the Sales Forecasting Tool, the Compensation and Benefits information, et cetera, et cetera. So it's an exciting new offering. And let's just, like for now, since we're talking about the OPR here, let's focus on that for a second. Within the OPR portion of the Business Intelligence Portal, there are the static reports, which I'm talking about, which is the industry-wide report and your company's individual report. But there's also something called the interactive CPR, which you can define what data groupings you want to compare your company's performance against, and it'll show your numbers versus those comparisons. There's also trend graph information, where you can decide what you want your numbers to be graphed against, and it'll immediately show you a graph for that purpose. And the same for report cards. It's on an interactive basis. You can decide what you want to be compared against from that standpoint, and it'll immediately show you that as well. So this is very exciting. I want to encourage you to use it. It's going to be available to you, and hopefully you'll get a great deal of benefit out of it. And as I said, in the OPR portion, it does have what we're talking about here, the industry report, the customized report about your own company, and then there's also something called the Financial Insights tool, which allows you to do certain what-if analysis. Okay, let's look at the results of this year's study, and I'm going to show you a series of charts that are all alike, and each chart is going to look at one measure. Here we're looking at before-tax return on net worth, and let's see how the industry, and this is based on all firms, has performed, and we're taking a look at 5 years here. Well, before tax return on net worth, as you can see, has gone up each of the last 3 years, and 2018 showed the highest return on net worth of the 5 years we show here. So by and large, 2018 was a very good year for the industry from a profitability standpoint. Bottom line profits as a percentage of sales, or profit margin on sales. This chart more or less mirrors the previous chart because profit margin largely drives return on net worth and return on asset performance. And as you can see, again, this has gone up each of the last 2 years, and 2018 was the strongest year. And interestingly, each of these, as we'll see in a little bit later, each segment within the industry actually showed higher bottom line profitability in 2018 as compared to 2017. Asset turnover, sales divided by total assets. This has been amazingly steady over the years, But what I've found in my experience over the years is this tends to change somewhat if there's an economic downturn, but basically during good economic times, good cash flow, etc., there's a great deal of consistency with asset turnover. Financial leverage ticked downward somewhat for whatever reason in 2018. This is defined as total assets to net worth, and basically it's an indication of how much you rely on debt versus equity financing. Now, keep in mind, as I go through these industry comparisons, it's nice to know what's happened in the industry, but what's most important is how you compare to your peers in the industry. So think it through as I go through this. How did you do on each of these measures? Payroll expense as a percentage of sales, and this is payroll including fringe benefits. This ends up being a very key measure because payroll costs are such a critical component of the expense structure for most companies. And in 2018, the typical company was at 16.3%. Again, how do you compare on this measure? Gross margin on net sales. Now, historically, we put purchase discounts or vendor discounts as a non-operating income item for purposes of the OPR. The reason for that was these were very insignificant way back when the OPR was first developed, but over the years they became more and more significant, and people started putting this as vendor rebates or purchase rebates as a reduction of cost of goods sold, which increases gross margin. Well, by the fact that the majority of the companies started to do that, we decided, well, for the purpose of the OPR, we need to show gross margin after purchase rebates. So about 6 years ago, we started doing that, and you can see that in 2018, gross margin after purchase rebates was 28.4% of sales for the typical company. Now, we still show it the other way as well, where purchase rebates are taken out of gross margin for those companies that still may do it that way. But basically, gross margin now is thought of after purchase rebates have been factored in. Inventory turnover, which is warehouse cost of goods sold divided by average inventory. And you can see this also has been very steady over the year as well. Well, gross margin should not be looked at alone. Inventory turnover should not be looked at alone, because you can be a company that's a high gross margin, low turnover company, or vice versa, you might be a low gross margin, high turnover type of company. So really you need to look at these in combination with each other. You need to look at gross margin and inventory turnover together. Well, it just so happens we have a ratio in the study that's a combination measure that takes both into account. And this is called gross margin return on inventory, or GMROI. And for the typical company in 2018, this was 137%. What that means is for the typical company in the industry, they earned $1.37 in gross margin dollars for every dollar invested in inventory. And you can see that 2018 was the highest of the 5 years shown here in that regard. Now, I might mention there's another measure in the OPR that does the same kind of thing. It's just calculated a little differently, and that's the Turn and Earn Index. So some of you may be used to using that. Others, GMROI, they are both in the OPR for your usage. Total operating expenses, a percentage of sales, another key measure also, because invariably when we look at the high profit companies in the industry, we find that they do a better job of expense management. So what your operating expenses as a percentage of sales versus your industry peers is critically important. And you can see that in recent years, this has not changed all that much, which is typical of good economic times. When the economy turns around and we go into an economic downturn, which eventually we will, we know that because the economy always goes through cycles. I'm not predicting anything here, I just know it's always going to happen. And when that happens, typically people who have not done a good job of expense management find that their operating expenses as a percentage of sales really shoot up because they have a lot of inefficiencies in the company. So I maintain if you do a good job of expense management, regardless of what's happening in the economy, that's going to probably benefit you greatly. average collection period on receivables, how long it takes you to collect your accounts receivable. The typical company was at 45 in the most recent years. This is also most recent year. This is also called days receivables outstanding. Net sales per employee. This is a personnel productivity measure, also very important because of the significance that people represent for the typical wholesaler. And again, how do you compare? In 2018, the typical company had $454,000 of sales per employee. How do you compare to that? That's what's most important. Percent sales change from the prior year. The typical company had a 7.3% sales change, which you can see was the best of the last 5 years. So again, profitability was up in 2018 and sales was also up. So by all measures, basically it was a good year for the industry. Now this particular measure is not an inflation adjusted measure. It's based on nominal dollar changes in sales. Okay, another way that you can get a good handle on your business, or it provides a good framework for analysis, is the profit model that's been around for years. And what this does is it shows you the pathways to profitability. And you can try to assess where your success and failure is based on what component of profitability is involved. For example, a part of this is profit margin, which is bottom line profits before tax as a percentage of sales. And what I'm showing here is all plumbing supply companies and all PVF companies. Also, a profit pathway is asset turnover, sales divided by total assets. Well, if you multiply profit margin by asset turnover, you get return on assets. Now, there might be a little rounding difference there, but basically, profit margin by asset turnover gives you return on assets. The beauty of this is if you find that your return on assets is low versus the industry, you can go back and see which of these two profit pathways might be the cause. And in the profit margin component, this is affected by gross margin, expenses, sales. The asset turnover component is affected by sales, inventory, accounts receivable, and all other assets. So the idea here is to determine where your possible problems might be. Well, the third profit pathway is financial leverage, total assets to net worth. And if you multiply financial leverage times return on assets, which we just looked at, you get overall return on net worth. So the idea here is which of the three profit pathways has led to your high or low profitability. And if you put it all together, profit margin times asset turnover is return on assets. Return on assets times financial leverage is return on net worth. So which of the three profit pathways are strong or weak for you, and then dive further into each of those to see what might be the issue. So it becomes a very good, useful framework for analyzing your company. Okay, thus far I've primarily focused on all firms in the industry. Let's shift gears a little bit and take a look at some of the four segments of the industry and see how each of the segments did based on the various ratios. And for this purpose, again, I'm going to look at a number of different ratios, and we're going to look at plumbing supply companies, PVF companies, plumbing supply and PVF, and HVAC and other. And the idea here is to look at which one of these categories you fall into and see how you stack up in that regard. Well, in terms of return on net worth, the highest performing group in the most recent year was HVAC and other companies. That's not always the case, but it was the case in 2018. And each of the four categories, well, three of the four categories had higher return on net worth in 2018 than 2017, but plumbing supply companies actually stayed the same. So they weren't higher, but they stayed the same at a good level. Bottom line profits as a percentage of sales. Again, this chart is largely a mirror of the previous chart because bottom line profits are a significant driver of overall company profitability. And again, HVAC were higher than the other companies in the industry. And in this case, all four segments showed higher bottom line profits as a percentage of sales than they did the previous year. Gross margin on net sales as a percentage of net sales, this is after purchase rebates have been factored in. You can see that the highest gross margin was for HVAC and other companies. The lowest were for PVF companies. But interestingly, that flipped around when we looked at inventory turnover. We looked at inventory turnover. The HVAC companies had the lowest inventory turnover, but PVF companies had the highest inventory turnover. So as I indicated to you, you can't just look at inventory turnover alone. You can't just look at gross margin alone. It's useful to look at the combination measure, which is warehouse gross margin return on inventory, or GMROI. And when we do that, we see that in 2018, the PVF companies had the highest GMROI, 163%, meaning that for every that they earned $1.63 in gross margin dollars for every dollar invested in inventory. All right, employee turnover. In 2018, plumbing or the HVAC and others had the highest employee turnover. The lowest employee turnover was by PVF companies. And PVF companies, for whatever reason, year in and year out since we put this ratio in about 6 years ago, have had the lowest employee turnover. All right, let's shift gears again and just take a look at the largest versus the smallest companies. The companies 150 million and over versus those that are 15 million and under. And again, look at some key measures. Before tax return on net worth, the largest companies had the highest return on net worth, or much higher, I should say, than the smaller companies, 21% versus 16.2%. And again, this was largely driven by higher bottom line profit margin. The large companies had higher bottom line profit margin than did the smaller companies. But quite interestingly, even though the large companies had the higher profit margin and higher overall profitability, the smaller companies had higher gross margins than did the large companies, 29.6% versus 27.5%. So that's kind of an interesting feature. And just looking at it a little further, the large companies had much lower total operating expenses than did the smaller companies. So the smaller companies had higher gross margin, but the large companies had much lower total operating expenses. So they're probably getting economies of scale by being large, but that's led to their high bottom line profitability. Inventory turnover also favored the large companies. So the large companies had lower gross margin, but higher inventory turnover than did the smaller companies. And then the combination measure, GMROI, or gross margin return on inventory, the smaller companies did better because of their higher gross margin more than offset their lower inventory turnover. So they had $1.47 of gross margin dollars earned for every dollar invested in inventory. Employee turnover. The large companies had significantly higher employee turnover than did the small companies for whatever reason. But interestingly, the large companies, every year that we've had this ratio in the OPR, which is about the last 6 years, the large companies have always had higher employee turnover. Okay, that's some of the look at the key measures for all firms and firms by segment. As I mentioned, you can get a great deal of insights about your business in a very short period of time by looking at the OPR information. So let me take you through a little hypothetical case example company, which I'm calling Tom's Plumbing and Heating Supplies Company. If there is a company of that name out there, I apologize because I've literally made up the your firm numbers here. This is a hypothetical company. I would never use anybody's actual results. So let me emphasize that this study is done in strictest confidence at all times. But let's say that Tom has come to you and said, well, here's my balance sheet and income statement financials. How did I do? Well, I don't know by just looking at the dollar amounts. I need to start doing some ratios. I need to compare them versus the industry norms, and that'll give me a different picture. So that's what I've done. So let's look at some key measures. First of all, before tax return on assets. Tom's firm is at 0.8%. All respondents were at 10.6%. So I'm going to raise a red flag there and ask Tom, why are you so less profitable than other companies in the industry? Same thing for return on net worth. Again, why are you not as profitable as other companies? There may be a very good reason for it. Maybe Tom has been taking money out of the business in various ways, and maybe there is a very good reason, but I need to know if I'm analyzing his business. Payroll costs as a percentage of sales, and this happens to be without fringe benefits. Tom's performance is higher than the typical company in the industry. He's 1% of sales higher in terms of payroll costs than other companies. So why is that? Gross margin is almost 2% lower for Tom than other companies in the industry as a percentage of sales. So again, I'll raise a red flag for that. His bottom line profits as a result of his payroll costs being high and his gross margin being lower is much lower than the rest of the industry. So I'm raising red flags. His sales change, however, is pretty much on par with the industry, so it doesn't seem like there's a problem there. Well, let's look at his operating expenses. Well, his selling expenses, very curiously, are 8.9% versus 7.8% versus other companies in the industry. So I'm going to question that because he's over 1% or he's 1.1% of sales higher there, but he's not getting significantly greater, he's not getting greater sales growth, so there may be an inefficiency there. Delivery costs are in line. Warehouse costs are below the industry, so that's probably a positive for Tom. His general and administrative or G&A expenses are substantially higher than the industry, so I'm going to question that. Is there an inefficiency there? Occupancy costs, pretty much in line with the industry. The net result is his total operating expenses are 26.2% versus 24.2% for the industry. So that, coupled with his lower gross margin, is not a good situation, obviously. Looking at some other measures, sales per employee, Tom's on the low side. His gross margin per employee is on the low side, so I'm going to question that. His asset turnover is okay, but his accounts receivables days are high. His inventory turnover is a little low, and his GMROI that we've been looking at, which is the combination measure, is somewhat lower. His current ratio, which is current assets to current liabilities, is right at or is a little bit below the industry, but probably not a significant problem. Most people say if you're at 2 times liquidity or current assets to current liability, you're in the ballpark. His financial leverage, somewhat higher than the industry, but not significantly, so I probably won't question that. So just to summarize, his profitability is low, but his growth is okay. He's probably okay on warehouse and delivery expense, but he has high payroll costs, poor personnel productivity, high expenses in terms of total operating expenses, but also selling and G&A expense, and his gross margin and inventory turnover are both low, leading to low GMROI. So the idea here is that in a relatively short period of time, we get a lot of insight about Tom's business that may not be otherwise possible. And hopefully, you can do the same thing for your own business. Look at some key measures, some of these same key measures, and let that dictate if you want to look at things in more depth, and then hopefully you find a lot of strengths. But if you see possible profit leaks, maybe it'll lead you to improving your performance. Okay, as I mentioned, one of the very useful components of the OPR each year is to look at the high profit company or profit leaders. And we do that for each of the various segments. For purposes of this session, I'm just looking at plumbing supply companies and PVF companies. And I want to show all firms plumbing supply, high profit plumbing supply, all PVF, and high profit PVF. And we're going to take a look at each of a number of key measures. So first here, I'm looking at sales growth versus the previous year. And you can see that the high profit companies for both of these segments had higher sales growth in 2018 than did other companies in the industry. So obviously sales growth may be one of their secrets to success, and in a few moments I'll show you why that may be. Bottom line profits as a percentage of net worth. Well, obviously the high profit companies are higher because we've defined them as the high profit companies. We actually looked at the measure before tax return on assets and used that to separate out the top 50% best performing companies in each group to define who is the high profit companies. But at any rate, I think the most significant thing here is that the high profit companies are significantly higher, and this differential would be much greater if I would look at the high profit companies versus low profit companies. In other words, the top 50% versus the lower 50%. I'm looking at the top 50% versus the all companies, which includes high profit companies in there. But if it's the top 50% versus lower 50%, these differentials would be much more significant. Bottom line profits as a percentage of sales really do drive overall profitability. And the high profit company did significantly better in terms of bottom line profit margin than did other companies in the industry. Gross margin as a percentage of sales wasn't a significant difference. It was a slight difference. The high profit companies for plumbing were slightly higher. The high profit companies for PVF slightly higher, but that wasn't as big an impact as operating expenses, which we'll look at. And here is operating expenses. The high profit companies for plumbing, 21.9% of sales versus 24%. For PVF, 22.4% versus 23.6%. So operating expenses obviously are a big component that led to their high profitability. And interestingly, this happens year in and year out. Each year that we look at the high profit companies, we always find this to be true. We may not find gross margin to be higher for the high profit companies, but we always find operating expenses are lower for the high profit companies. Inventory turnover, it was actually absolutely the same for the high profit companies, but high profit plumbing supply companies, but in the PVF group, inventory turnover was substantially higher. Okay, here's that new measure, which is estimated percentage of inventory that is dead stock. That's inventory that hasn't sold for a year or which you have more than a year of supply in inventory. And for the typical plumbing company, this was 4.8% for the high profit companies versus 5% for everybody overall. On the PVF side, it was 2% versus 3%. So in both cases, the high profit companies had less inventory that was considered to be dead stock. So I would suggest, probably do a better job of managing their inventory. Payroll costs, including fringe benefits, also favored the high profit companies for each of these two segments. And as I mentioned at the outset or earlier, this is a key measure because payroll costs represent such a significant component of your financial expense structure. As a matter of fact, payroll costs represent something like 60% or over 60% of gross margin. So it stands to reason that measuring personnel and payroll is critically important. Sales per employee, which is a measure of personnel productivity, also favored the high profit companies. And again, how you compare is most significant, but it's also interesting to know how you compare versus the high profit companies. And if your sales per employee is high, you're probably going to get good personnel. You're probably having good personnel productivity, and in all likelihood, your payroll costs are going to be under control. Employee turnover, we get kind of a mixed reading here by looking at the high profit company versus other companies. On the plumbing side, the high profit companies had lower payroll or employee turnover, but on the PVF side, the high profit companies had somewhat higher employee turnover. average collection period on receivables or days receivables outstanding. Again, somewhat mixed, pretty close to the same in terms of the plumbing, slightly lower in terms of the PVF. Financial leverage, in the case of the high profit companies for both segments here, financial leverage was somewhat lower, which is not surprising. If they're more profitable, they probably have more money to devote to the business and have to borrow less. Okay, well, what have we learned then by looking at the high profit companies? Well, first of all, sales growth was higher in 2018 for both of the two segments that we looked at. Obviously, profitability was much higher. That's how we define them in the first place. Profit margin on sales, bottom line profit margins on sales was much higher. Gross margin was not substantially different. Payroll costs was higher. Higher sales per employee, much lower total operating expenses as a percentage of sales. They had similar average collection period on receivables, but the high profit companies had lower financial leverage. They also had lower employee turnover for the plumbing companies, but somewhat higher for the PVF companies. Well, some of these conclusions are things that we have found year in and year out, which leads us to kind of summarize what are the critical components of success in the industry based on what we have learned by looking at these high profit companies over many years of the study. And I don't mean to be trite, I don't mean to be redundant, but we have found year in and year out that expense management is a critical component of success in the industry that differentiates the high profit companies from other companies in the industry. And I think a big part of that is something I call expense creep. And that is, the industry did well last year. There's no question about that. Well, we had a great economy last year. And what I found is that when the economy is good, when cash flow is good, when profits are up, which pretty much typified 2018, then oftentimes people don't do as good a job of expense management as they do when things tighten up in the economy and suddenly they have to tighten up on the managing of their expenses. So expenses creep up during the good times. And any inefficiencies sometimes go unnoticed until a recession occurs. And we know eventually there's going to be another recession. We always go through cycles. So that's why I maintain that if you do a good job of controlling your expenses and controlling your business, regardless of what's happening in the economy, you're going to be well positioned for the next economic downturn, but you're also going to maximize your profits in the short term. And when I'm talking about expense management, I'm not talking about just unilaterally going out there and cutting costs. That's going to do more harm than good. What I'm talking about is looking for ways to be more effective, more efficient, that results in lower expenses as a percentage of sales. And we know by doing the study that the high profit companies have lower expenses as a percentage of sales. We've already taken a look at this for PVF and plumbing companies, and their total operating expenses, the high profit companies, is lower as a percentage of sales. So that's a big part of their success without question. And I think it's largely because of the fact they just simply do a better job of controlling expenses. But in addition, I think it's also because of the fact that at least in 2018, the high profit companies figured out a way of having also higher sales growth. And what happens is, if you get incremental sales growth, it drops a disproportionate amount to the bottom line and helps your overall profitability. Well, that's kind of a mouthful, so let me show you what I mean by that. And what I have here is a very simplified P&L or income statement. And let's say your company does $50 million of volume of sales. Your cost of goods sold is 80% of sales, so that's $40 million. Let's say your variable expenses are 8% of sales, or $4 million. Variable expenses being things that change if your sales go up. Let's say your fixed expenses, which are fixed, at least in the short term. If you get greater sales, your fixed rents don't go up, and other fixed expenses. let's say for simplicity, that's also 8% of revenues at this current volume level, or $4 million. So the result for this company is it drops $2 million to the bottom line, which is 4% on their $50 million of sales. Well, let's say this company figures out a way of getting $5 million of incremental sales, or a 10% sales increase. Well, what happens on this $5 million of incremental sales? Well, first of all, we're going to assume they got this increase in sales not by cutting prices. So cost of goods sold is still 80%. So that represents $4 million on the new $5 million of sales. Variable expenses, we're going to assume still are 8% of sales. So that's $400,000 on the new $5 million of sales. But fixed expenses are fixed, at least in the short term. So fixed expenses drop to the bottom line. And as a result, bottom line profits are $600,000 on the new $5 million of sales. So that is a 12% profits on the new incremental sales. So you can see that if you can spread your costs over incremental sales, it's going to drop a disproportional amount to the bottom line. Well, obviously, this is a great simplification because in reality, fixed expenses are not fixed forever. Eventually, you have to build more facilities, more warehouse, have more trucks, etc. And there's also your variable expenses. Some are semi-variable, some are semi-fixed, etc. So this is a great simplification, but the point remains that if you can figure out a way to get incremental sales, it's probably going to drop some proportion to the bottom line that's higher than your overall profit margin. Okay, also, we've talked about the importance of turning your inventory, and certainly accounts receivable are important, so turning your accounts receivable are important, or collecting your receivables. Well, oftentimes the turnover component is overlooked. We tend to focus on gross margin, but miss out on the turnover. So this little chart is designed to try to illustrate what I'm talking about. Let's say a company has $10 million of cash to do something with, and you're in business to make money, so you take the $10 million and you buy products, so now you have something I'll call cost inventory of $10 million. You mark it up 20%. This is different than gross margin. This is markup. And now you have inventory for resale of $12 million. So hopefully you sell it. If it was a cash sale, it goes to the top as $12 million of new cash to be put through the cycle. In all likelihood, it's going to be an accounts receivable sale or a credit sale. So the $12 million will go into accounts receivable. Eventually, it's collected, comes to the top as $12 million in new cash that can be put through the cycle. And the idea is the more times you put it through the cycle, the more successful you're going to be. The more successful in terms of cash flow, the more successful in terms of profits. So that's why inventory turnover and turning your accounts receivable are very important. If it gets stuck here as inventory for resale, then that's money that can't go through the cycle, can't grow for you. Same for accounts receivable. So that's why those are both important. And that's why in the OPR, we have measurement tools. We have measurement tools for inventory turnover. And I keep saying that it needs to be looked at in conjunction with gross margin, because turnover alone isn't the only name of the game. It's the combination of gross margin and inventory turnover, and that combination measure, gross margin return on inventory. But at any rate, if you measure it, you're probably going to get a better handle on where you stack up. And keep in mind, if you have excess inventory, it's probably costing you. These are some of the estimates of what excess inventory might be costing you, and these are just gross estimates, but it could theoretically be costing you 20 to 25% of the value of that excess inventory. So if you have $100,000 of excess inventory, it's possible that could be costing you $20,000 to $25,000 just in inventory carrying costs. So another reason why managing your inventory is critically important. Well, to manage your receivables, the same thing. Measure it. And we've looked at accounts receivables days outstanding. which is 45 for all plumbing firms, 49 for all PVF firms. You could also look at aging schedules, and that also is important for measuring your accounts receivable. Now, another little thing I'd like to share with you is the issue of your sustainable growth rate. And what this gets at is a concept called cashless prosperity. I can't tell you how many times I've had companies come to me and say, Tom, we're doing great, we're profitable, our sales are up and everything, but we have no cash. Well, it may be that that company is growing faster than their sustainable growth rate. And all this is, it's a fancy term, but all this is profit after tax minus dividends over net worth. So if you have $5 million of profits, you pay out $2 million in dividends, you have $50 million of net worth, you do the calculation, 5 million minus 2 million over 50 million, that gives you 6%. So that means that your sustainable growth rate is 6%. That means you can grow 6% through internally generated funds without having to go to outside sources of financing, such as new debt or new equity financing. If you grow faster than that, then you probably are going to have some cash flow problems, and you may be experiencing cashless prosperity. If you grow slower than that, then in all likelihood you'll have good cash flow and you'll be throwing off a lot of excess cash. So the sustainable growth rate is in the study. There is information that explains it, and hopefully my explanation will help you with that as well, and that'll give you a sense for whether or not you need to go to outside sources of financing to grow whatever growth your business is. Okay, so just to kind of summarize some tips to look at the study, start off by looking at some key measures, and my next slide is going to identify what I consider those to be. Look at your company versus other companies of a similar type and size as your company. And then if you really want to get sophisticated, look at your company versus the profit leaders and recognize that significant differences between your company and the industry norms are not necessarily good or bad, but they are indications of things you should look at in more depth. We're trying to raise red flags here of things to look at in more depth because we realize that everybody is different, and there's going to be very good reasons why you are different for many different measures. Here are largely the measures I've focused on in this session today. These are what I consider to be the 15 key measures to focus on first and let that dictate what to look at in more depth. For example, if you look at total operating expenses as a percentage of sales and you see that you're out of line, then look at the operating expense detail, the selling expense, the delivery, the warehouse, the G&A, and see where you might pinpoint where there might be a problem. If you do this, then hopefully it makes analyzing your company as simple as that little simple hypothetical company that I took a look at. And what areas should you focus your efforts on? Well, we saw that expense management was key as separating out the high profit companies, certainly personnel, certainly accounts receivable, and certainly inventory management, all key. And again, I'd like to emphasize that the new business intelligence portal is going to be very exciting for you to use. We have, and looking ahead, we still have a favorable business climate in general, but there's indications that there is a recession, could be a recession looming. We know that the economy always goes through cycles. There's certainly geopolitical pressures out there lurking, such as Russia, China, Iran, tariffs, etc. There's upward wage rate pressures going on right now. But on a positive note, we still have low inflation, low interest rates, less stifling government regulations, low unemployment. Our unemployment rates are the lowest they've been in 50 years. But before we get too excited about that, low unemployment tends to be a lagging indicator for an economic downturn rather than a leading indicator. So I thought I'd just throw that out. So hopefully this has been a useful session for you. I'd like to turn it over to Ayesha. She wants to make some final comments for you, and thank you.
Thank you, Tom, for an excellent presentation and the insightful information you shared with us. And thank you everybody for participating in today's webinar about the American Supply Association's 2019 Operating Performance Report. Again, this webinar is being recorded for replay, and all of you will receive a follow-up email message with notification as to when the replay is available, as well as instructions on how to access it along with the presentation slides. I would like to remind you all that registration is still open for Network 2019, which is being held at the Grand Hyatt in Washington, D.C. this September from 25th to September 27th. With more than 84 wholesaler firms already registered, we are well on our way towards reaching our goal of having different distributors represented, and all indications clearly point to another very successful annual all-industry event. Visit www.asa.net for complete information. We value your feedback and would love to know your response on the quality, information, and content of the webinar. Therefore, I will be sending out a short survey to all the registrants. It will only take a few minutes of your time. I'm Aisha Salman, and on behalf of ASA, this webinar is now concluded. Good day.